Good afternoon and good morning, everyone. It's Ted Bader here, President of SIA Wealth. Thank you for joining us again on our weekly webinar, providing a market update to all clients of SIA Charts and SIA Wealth. Hope everyone is staying safe and isolated at home. I think now all the bugs have been worked out from their home offices, and I'll be curious to see in the next couple of months how many people are really looking forward to going back to a big office building somewhere, at least on a regular basis. So we're going to get started. This will be more of a market update with Jeremy Fehr, obviously talking about what we're seeing in the markets, but a couple of housekeeping items. If anyone has questions at any point, we will do a Q&A at the end, but you have to type in your questions onto the question tab for the GoToWebinar. So once you if you go through any questions as they might pop up regarding Jeremy's outlook, any questions you might have on the funds, et cetera, we're more than happy to answer those at the end. In addition, you can always, we've always had a bit of a crush as people start to dial in at 2 o'clock. So I think there's less problems now as we go through it, but we have waited a couple of minutes to get people on. We also do provide a webinar replay with the slides and the PDF, and we have a YouTube channel. So if you go to YouTube and you type in SIA Wealth, hit subscribe, and all of these webinars and any ones you might miss in the future will be posted on the YouTube channel. So without further ado, I'll kind of get in quickly with my quick part of this. How can SIA Wealth help portfolios? And we've been talking about this for the last little while, about what to do, and this is still the biggest question. We've had a pretty significant rally off the bottom. If you want to flip to the next slide, we've had a pretty significant rally off the bottom, and we're getting a lot of questions from advisors saying, well, are we going to go back into the yellow or the green zone? What is SIA seeing? What is SIA saying? And the reality is we're in the same position now. Our market's going to continue to go up, and if so, then we will get invested. Or markets potentially have another leg down. And what's that situation? So today we're in the red zone still. Jeremy's going to talk a bit about that. But the reality is, I keep on saying this, and it is a matter of hope for the best, prepare for the worst. You as advisors, a lot of your clients are business owners. And as you're talking to them over the last few weeks, because there's really nothing else to do except talk to people, via email or phone, is they understand that their businesses are going to be fundamentally affected by this coronavirus lockdown for the next few quarters, to say the least. The bounce back we've seen up in markets, it could be a don't fight the Fed scenario, where if the Fed is going to buy everything and at some point eventually buy stocks, then why bother fighting against it? But there's a lot more people that are looking in a bigger situation about trying to manage that risk. And that's exactly what we're saying here. What we're trying to do in the funds we run is to prepare for a worst case scenario, but we will always start to hope for the best. So if you go to the next slide, again, history doesn't always repeat itself, but it rhymes. This is our equity action call in 2008. As you can see, when we went red, which was in January of 08, the market rallied from that low up until about 24% up to the high. We actually went from the red into the yellow zone, and there was a lot of clients asking if that was a signal to start buying equities again. And as we all know, what happened after the fact is that was the peak of an even worse decline. So we don't know if this is the way things are going to play out, but I would much rather prepare for the worst. And again, that's a key point, is to talk to some of your clients as business owners and see how this is really going to affect it, and see if this is going to come out in the wash with more bazooka wrangling by the Fed. If you go to the next slide, I do get a lot of clients as well who ask about buy and hold. And there's a lot of people who have held on to positions and they've gone down and then they've come back up. So obviously buy and hold does seem to be a strong opportunity if the market stays where it is or continues to increase. However, we get the argument of the 10 best days occurring in the market, and if you get out of the market, you miss them. The reality is that the 10 best days over the last 20 years have occurred during 3 bear markets. The best and the worst days occur together, and then it's called volatility clustering. So we're not trying to present a pessimistic viewpoint. We are hoping that markets continue to rise, and we want to participate in that. But again, we're trying to prepare for the worst and understanding what the reality is and how we can have a conversation with clients about what it is about missing some of the best days because you're trying to get out of the way of a bear market. And that ties into what we're trying to do here at SIA Charts. Again, we're not saying have your entire portfolio be tactical. We're not saying sell all your equity assets and go to cash. If you go to the next slide, everyone has seen this for the last few weeks. What we're really saying is add that tactical sleeve. And now is actually a fantastic time. If you've written that down, if we all experience that decline in March and the rise back so far the last couple of weeks, it is a really opportunistic time to take some of those weaker positions off the table and allocate it into a tactical sleeve. Currently, we have 0% equities in all of the BMO funds we manage, and as such, we're going to be a risk mitigating tool. Again, if you run a 64-40 portfolio with a 20% allocation to some of our equity funds in the red zone, it will actually be a 40-60 portfolio. You're preparing for the worst. If we go back into the green zone, we will get fully invested again, and your client will be back up to 60-40. That means that you're going to have 40% today still invested in equities, and that's a very large allocation, but we understand that people have to balance off that risk. So that's exactly how we're trying to position this, more of a balanced approach, trying to mitigate the risk and prepare for a worst case scenario, but let's hope for the best. So the final slide that I tend to show as well is what this means without a pure equity allocation. It's more of a balanced approach. And this just shows you, as we go from the red, the yellow, and the green zones, what type of an allocation you would have with some of the funds we run from BMO. We've had a lot of success over the last couple months raising assets within the BMO funds. And there's two main ways we're seeing it. One is advisors who've raised cash and are looking to or have too much cash on the books, have bought some of our ETFs and funds because although they are labeled as equity, they have zero equity exposure right now. And the second way is we are seeing a lot of advisors start to build into this tactical sleeve, whether it's an alternative sleeve, whether it's a tactical sleeve, whatever you want to call it. They're introducing some of these funds which are doing exactly what we said they're going to do, which is getting out of the way of the market. So that was my pitch. More than happy to have conversations with anyone if you want to follow up afterwards or ask questions. But right now I'm going to turn it over to Jeremy, and he's going to give you the market update for today.
Thanks, Ted, and thanks everyone for taking the time today. We know it's a hectic schedule, dealing with clients, especially remotely, with all your support people around you at all times. So we know your time is valuable, and certainly very interesting markets these days. So I'm going to go over just where we're sitting today. As Ted mentioned a little bit earlier, we have seen a rally in the cap-weighted market indexes. So we'll touch base on that, and we'll take a look at what we're seeing for our broad-based indicators across SIA Wealth. So the first chart I want to start with is our SIA Charts Equity Action Call. So this is our top-level indicator. Again, if we're in the green zone, we're going to be 100% of our equity exposure. In the yellow zone, we'll be in a hold process. And where we sit today and where we've sat for just over a month now is in the red zone. If you look in the bottom right corner, it's a little bit hard to see on the screen here, but we have moved up in the red zone. So a lot of people are saying, hey, Jeremy and the guys, we're seeing the major indexes rally here. What's happening with the equity action call? Well, they've moved up now to the very top of the red zone. So we're encroaching on the yellow. We're not there just yet. And again, for our BMO sub-advised products, the yellow zone still remains a no-fly zone as far as problems. If we look back a little bit to the left, you can see in 2008, as Ted highlighted a little bit earlier, we did see the yellow zone, and that was just the predecessor of the major decline that happened in the summer and fall of 2008 and carried over into the first quarter of 2009. So again, we still sit in high-risk area. What this means is that our measurements of equity versus alternative asset classes remains negative. So cap-weighted indexes, as we all know, are extremely weighted to the larger companies within there. We measure everything on an equal weight basis. And so what this is telling us is that we're not seeing the money flows go to equity that maybe those cap indexes are showing us on their screen. As far as our asset class rankings, our second level of analysis, quite a bit of change over the last week. So We've seen currency move from the first position into the second position, with cash moving up to the top. This is really just showing us that the safety play has moved away from foreign currencies, euro, Japanese yen, and others overseas, and has moved into U.S. And Canadian treasuries at a greater rate. So we see that fundamentally it doesn't change anything about what is happening in our EAC or our asset class rankings at this time. Both of them are equally negative, being in the top two positions for equities. The major move this week is bonds. We see that move from the third position to the fifth position and being displaced by international equities and commodities over that time frame. So international equities have rallied up a bit more, seeing more life over there, particularly important probably because of the COVID crisis. There is more information coming out of those jurisdictions, and the COVID-19 crisis is longer in the tooth over there as well. Commodities moved up. Gold has been largely the main driver of what we've seen on the commodity side. Certainly, there has been some rallies in crude that were short-lived based on the agreement with OPEC and the Russian oil industry. So they've come to terms, and we saw a brief rally, and we'll get that chart later. U.S. equities has moved down. That would be a surprise for many, given the fact that the S&P 500 has done extremely well. But again, if we look at it on an equal weight basis, if we measure U.S. equities, the sum of that equity market has really not done as well as those cap-weighted indexes. So that's an extremely important thing to note when we're looking at these asset class rankings, and really signify more risk in that market than one would expect. And then finally, Canadian equity, buried in last place in seventh, remains in that position. So that's the only asset class that didn't change over the week. It is possible, if commodities remain stronger, that we will see Canada move up, but we don't see any evidence of it at this time. So this chart here, the first one we're going to look at today, is the SIA Market Equal Weight Index versus the SIA Cash Equal Weight Index. This is an important chart for us to look at. Cash is currently the #1 ranked asset class. We can see in the comparison chart when we have the red line going down. If we look to the far left, this is from 2007, approximately July, August of 2007, right up until March, April of 2009. We had a strong decline down. This is when equities are underperforming cash. When we have the green zone, so from March, April of 2009, right up until recently, we've seen a very, very strong uptrend in 2011 and 2016. We did see brief red zones. Those were small declines in the market relative to what we've seen recently. And now we see we're again in that downward trend. So short term, we have seen a column of X's. Equities on a very short term basis are outperforming cash. Certainly there has been a rally there. But even the SMAX score, our shortest term technical indicator, when we look at these, still registers as a negative. So this bounce that we've seen back is to be expected after grossly oversold equities. And certainly with the central banks around the world, the Federal Reserve, Bank of Japan, even Bank of Canada now purchasing ETFs to help shore up the market. And last week of the announcement of the Fed purchasing junk bonds, this has added some steam and some pressure upwards on some of these indicators. The next chart is the SIA Market Equal Weight Index just on itself. So I wanted to show you this. We've seen a short-term relative strength move to positive. Our SMAX score is positive on this, so that is slightly bullish. We've seen it move up. We've seen a 50% retracement now from a downside. Again, this is right in bull market or bear market type of rebounds that we would expect. It was a very strong, fast, and steep decline that we had in the stock market in February and March. Certainly seeing a bounce back like this from oversold, especially with so much interference by the central banks and governments around the world. Nobody's really going to remain on the short side of the marketplace when the Federal Reserve and other central banks are coming in and having tremendous influence on equities. But again, we've hit that 50% level. For many of our clients, they've been asking me, I missed this downturn. Where do I find a position to get off of some equity exposure, get into your funds, which are now showing zero equity exposure, we're at that point. So we're at key resistance, that 50, maybe even up to about 60% level is a natural retracement in these types of bear markets. So again, we're at that level right now with that strong resistance overhead. On the cap weighted side, I still want to show these charts because this is what your clients are seeing. This is largely what you're seeing on BNN and CNBC, the S&P 500. So short term relative strength has moved positive. We've got a 6S max on it. We've seen the largest retracement from drawdown on this for a broad base benchmark, a 60% level back. Again, this resistance level that's capped here is something that I've had on the chart for a number of weeks here. We are at strong resistance, and we remain in a downtrend. So for those of you who have been looking for an opportunity to lighten their equity exposure, if you're of the mindset that there's still more on this, then this is the levels where you want to be taking an interest in that. So again, we're now sitting on the S&P 500, at the same levels that we were seeing September, October of last year, even December of last year is where we're valued at. All that's left to the upside is everything we saw pretty much December, January, February left in the marketplace. So very, very strong move back up. But again, let's keep it in perspective. If we look at, for example, the Russell 2000 index, again, a cap weighted benchmark, but I wanted to really highlight the differential and where we're sitting. So this chart to sit in the same position of where the S&P 500 would have to move up another 14, 15% to be at the same level. So we're seeing this rally happen in the cap weighted. That's to be expected. With the influences coming from central banks and their purchase of ETFs, as well as their shoring up of the junk bond market, certainly has created an opportunity for an extensive short squeeze from that decline, but it's not carrying across all equities. And this is an important part of what we do. So we see the Russell 2000. It's still short-term negative. It hasn't seen that rally back. It's retraced about 40% of its drawdown, and it's sitting again at strong resistance as well. So the best way to look at them is to do a comparison chart. So we've got small caps here. We've got the Russell 2000 small cap index versus the S&P 500 large cap index. So we see that large caps, if we look at the chart, we'll see that the green on the left side here is small caps outperforming large caps, and we see that coming from 2000 all the way up until 2007. We have some back and forth motion, but if you look in 2008, 2009 coming out of that, you'll see the small caps accelerate. But largely from 2007 right up until 2020, we see extensive sideways movement between large and small caps in that tie base. And that's not probably going to come as a large surprise to those on the call today, as we've seen benchmarks harder to beat. But probably what we're looking at in that scenario is really some of the problems highlighted post 2008 really not coming to help the market in a broader sense, where we see those small caps starting to catch up. And certainly that movement to ETFs over the last few years, again, has made it more difficult. But what we're seeing recently and in this downturn is the large caps are dramatically outperforming the small caps. So that's not a broad-based rally. We would want to see this chart improving with the broader market starting to improve those large caps before we would likely see a green equity action call. The next chart I want to look at, and I didn't have this chart on last week, is the S&P TSX Composite Index. It's been in a sideways movement, really, going back to 2007. We're sitting at near the highs that we saw in 2007, pre-2008. The market has not done as well as other global benchmarks, but again, its rally back has been about 50% of its downturn over the last couple of months, now sitting right against strong resistance. So again, those looking to take advantage of a likely a very short-term opportunity to pull some more money to the sidelines, this would be it. And one of the problems that still faces Canadian markets is the price of crude. We saw last week some potentially positive news coming out between OPEC and Russia, where we saw them reduce production, millions and millions of barrels. That does not seem to have helped the price of crude as of yet. We're now sitting at the bottom end of the range at key support just above 1987. The next support level is in that low 17 range. So we're watching this chart closely. We should expect that if we break down below this, this could add significant pressure to potentially, certainly the energy side of the Canadian marketplace. And we see WCS crude is under tremendous pressure again, being the Canadian benchmark. So again, not a lot of great news on the energy front at this time. With that, this was a short overview today. Really, again, just highlighting that we've been talking during this rally over the last couple of few weeks, that we're going to hit these resistance levels, hitting them, and the tremendous pressure that's been happening with the Federal Reserve and other central banks' influence coming into the marketplace. We have seen the cap-weighted indexes rally, but we have not seen a broad-based rally that's going to bring the equity action call into the green zone as of yet. So we look at this as a short-term opportunity to potentially take some more money off the table for those of you who may have been caught with too much exposure to equities down during the downturn and now seeing those equities come back. Now is a good time to look at those SIA Wealth Management BMO products, which are going to have zero exposure to it. So with that, I think we're going to jump to questions. Ted, do you have those questions in front of you?
Yep. We have a couple questions, but if anything pops up, please feel free to type it out in the questions tab. One is your thoughts, Jeremy, on the Canadian-US dollar.
Yeah, great question. I thought about having that chart in here. It hasn't adjusted very much. We're sitting right around support level on that. The US dollar had a strong rally up. Really around that 140 level is support. 139, 140 is the support level, sitting in column of 40. So still in a bullish upward trend. We would tend to be more bullish on the US dollar over the intermediate term. Short-term weakness was to be expected because we hit key resistance above. So we should just, if you're looking to position into US dollars, now would be a time to take some of that position and put it on. Again, sitting at resistance on our equity markets, we've seen a strong correlation weakness in the US dollar as the equities have rallied. We would expect the opposite if equities were to weaken off in the short term.
Okay. There's a related question to this. Well, kind of. There's a question about the asset allocation fund. And an advisor was asking, 40% of the portfolio is in short-term bonds, and 60% of the portfolio is in a larger bond portfolio. So a couple questions over the last couple weeks is we've seen a bit of a decline in the asset allocation fund. One of the reasons for that is because the entire portfolio is not in all short-term bonds. We actually have U.S. Bond exposure. We actually have some long government bond exposure as well. So those bonds fluctuate in price, and what you're seeing is a play on the a bit of U.S. dollar exposure, as well as some bond exposure, which has been longer bond exposure, mid to long-term bond exposure, which has affected it. But that's exactly what we're seeing. We haven't, like, our asset allocation fund, for example, 60% is in a tactical bond fund. That is moving. We're trying to position it according to where the strength is. And again, like Jeremy just mentioned, we are seeing an opportunity, and the strength is in the U.S. dollar. So that will affect some of our portfolios, but it's not going to be, straight across the board. And it's going to be a lot of volatility in the markets. But we are seeing by the end of this, you are going to see a strength in the U.S. dollar, and that's exactly how our portfolios have been positioned. Another question, Jeremy, was the yellow zone. You touched on it briefly. How quickly? A lot of advisors ask the question on how much does a market need to go up or down to have a change in our equity asset class. You mentioned a bit about the equal weighted index that we're using. Is there anything else that you can kind of share with us about the equity action call that makes that changes?
Yeah, and again, the EAC is largely powered by U.S. equity, Canadian equity, international equity versus cash currencies, bonds, and commodities. So if you look at the asset class rankings as we sit today, we saw commodities rally up on there, bonds move off, but they largely equalize themselves. So international equity has moved up. U.S. equity actually moved down over the past week. So we have to keep in mind that those indexes, those cap-weighted indexes are rallying. That's really the trap at the end of the day. They're much, much easier to move. This is a situation that is hard to combat verbally, because when you're talking to clients who are watching the screen, maybe they're feeling that pressure. But as Ted mentioned earlier, you know, most the upside with the downturn that we've seen recently is that most of the people who are business owners or professionals that are our clients are well aware of the problems in this economy right now, because their businesses are being dramatically affected at this time. There's only a few businesses that would have escaped this, largely not in the realm of what most of our clients are going to be doing for a living. So when we look at this, things have not improved on our asset class rankings as much as people might think, given the movement up there. We would expect cash and currency. When we see those at the very top, that's the most negative of situations that we see. That's money looking for the safest of places to be, which is U.S. Treasuries, Bank of Canada Treasuries, you know, Bank of Japan Treasuries, European Union Treasuries. So that's where the money flows have been. That's where they're going. This spike up in equities has only been a small portion of the cash flow that's been moving around out there. Most of it has still been avoiding risk and avoiding equities. So when that changes, how fast can that change? We saw in 2002, that was within 5 days of the bottom of the market. We were able to see it. In 2008, it took a couple of months for that to show up. It's going to be different every time. It's going to depend on how dramatically different it goes. So if cash and currency start to get those withdrawals that we would want to see when equities are coming back, that money goes into equities, that differential will actually double, and it happens extremely fast. So what we're seeing in these asset class rankings is that we should expect lows to be tested again.
Okay, I have another question here saying that there's many people out there saying that we've hit the bottom in March and we will not see a retest of these lows, but would a retest be a normal pattern of a bear market rally?
Yeah, I would say so. I mean, you don't have to get to the lowest lows on that. I'm just going to pull up this chart here on the SIA Market EWI. As a technician, I would expect us to probably at least retrace back into that 48,000 range. The bottom of that red zone would be a natural retracement on a near term. You know, looking at this just purely technically, if we continue to get deteriorating fundamental information as that information hits the market, which we've seen many of the forecasts coming out of the banks this week talking about dramatically lower GDP than what the World Bank has been talking about, and certainly a longer term problems for the economy well into 2021. We'll see how the market reacts to that, but on a forecasting basis, we could still see levels in that 40,000 range. So down to the lows of 2016 on a technical basis would not be out of the realm of possibility in a bear market situation like this. This is really just the second leg of a bear market. We saw the collapse come down very, very quickly. That would have been very similar to what we saw in 2008 from July 2007 right up until a year later. We saw a slight decline. The market was gone down 15% or so, and then we had the steep decline. All that phase happened in one shot with COVID. It was in the COVID crisis made what happened in 2008 happen a lot faster. We saw a rally back from that again into that yellow zone. We saw that happen in 2008, and that was really the trap. So that's what we're looking at here in that second phase, is just that grossly oversold, grossly over-shorted, and now well-funded by the Fed and other central banks and governments around the world throwing everything they can to hold this. But then you have to have that information come out, and that's when you see those next legs down.
And this relates. Next question relates back into the bond fund. Would we have added any high yields? I guess the question is, given that the Fed is purchasing high yield ETFs, would we have added any high yield fixed income ETFs to our bond portfolios at this time? So we've done a lot of different testing. I'll let Jeremy explain kind of the high yield position and why we only buy investment grade bonds in the bond fund.
I think I'll let Paul Vandrinsky, our portfolio manager, answer that.
Yeah.
Yeah, sure. It's a good question. With our bond fund and with the bond components within the asset allocation fund, we're actually restricted to investment grade names only. So quick answer to that is no, we won't be doing that. We've done a lot of, prior to the rollout of these funds, we did a lot of testing and we found that the addition of high yielding products in our back test on a risk to reward basis didn't show us based on possible returns that it was worthwhile. And then it worked out because a lot of advisors who were looking at the funds coming out told us that too much or any allocations to high yield would restrict them to certain percentages. So quick answer is no, investment grade only within the two funds.
So I guess the question is, has the game changed because the Fed is now buying up high yield bond indexes? And that's a very difficult question to answer. And I still think from our point of view, the answer is no. Paul, I guess, could you clarify that? Because has the game changed a bit regarding high yield?
Has the what? Sorry?
Has
I'll
the
jump
game
in.
changed?
Yeah. The game, in my view, hasn't changed. Jeremy here has not changed because the work that the Fed's doing is only because of an extensive crisis. They would never want to go to the junk bond market and put that on their balance sheet unless we were in unusual times. So that's their efforts to shore up the bond market, the junk bond market, to avoid some of the defaults and certainly the lack of liquidity that was in the marketplace as people were forced to find liquidity and couldn't find it in junk bonds, couldn't find it in corporate bonds, couldn't even find it in some government issues. That was just their willingness to come in and shore that up, but they certainly don't want to be long-term holders of that junk. That's where most of the defaults are going to happen over the next year or so based on the shift in the economy. So Paul, if you want to add to that.
That's a good explanation, Jeremy. And that's, yeah, because of that. I was also on regard to what we're restricted to purchase too, but we'll see what takes place going forward. Within the portfolio, we did have corporate bonds, which obviously did see the greatest volatility, but general shift out of that within both of the funds took place over the last month. So into the longer term governments, but we're still seeing volatility at all levels within the fixed income for the time being.
Right. Okay, so that's it for the questions. I wanted to thank everyone for joining us on the webinar today. We're going to do it again next week. And if anyone has any questions, feel free to reach out. Like I said, we have the replays in the YouTube channel available, and we can send out the slides as a PDF to anyone who's interested in them. But in the meantime, stay safe. It'll be curious to see what happens next week, because it almost does seem that things are changing on such a fast basis that who knows what will happen by next Wednesday. So thanks, everyone. Stay safe, and I'll let Jeremy sign off as well.
Yeah, thanks again, everyone. And again, I just want to reiterate that we are at key resistance, so there is opportunities here if you are looking to move off positions and take position in the BMO funds that we sub-advise on at this time. So we've been asked that question. I get asked that question every day. I just spent a lot of time talking with advisors saying, you know what, wait till we get to that resistance level. We're at that resistance level. So if you are interested in that, give us a shout. And again, just as Ted mentioned, we're available anytime. If there are things that happen between now and next Wednesday's market update, we'll certainly get that information out and do another webinar in the interim. Thanks again.